Welcome back to the deep dive. You know why you're here. The world throws just mountains of data at you every single day. Our job is to filter that noise, not just, read the headlines, but to pull out the key structural movements, the handful of events that actually shift the global landscape. We want to give you that knowledge quickly, yes, but also thoroughly. Okay, let's unpack this. If we have to boil everything that happened yesterday down into a single movement, what is the simplest way to summarize the state of the world?
Okay, so the concise vector, the main theme for yesterday is this. The incredible acceleration we're seeing in digital fields, especially in AI, is now being very, very clearly constrained. And it's being directed by physical resources and regulation.
So digital growth has hit a physical ceiling.
A very hard one. And you can see the global flow of capital is shifting almost immediately to address these new bottlenecks in energy and resource traceability and just plain old physical location.
That is a profound shift. I mean, for the last decade, we talked about code and software as the dominant force. But now, it's like you're saying, electrons, water, and government permits are the ones taking the steering wheel. Let's jump straight into the three deep topics then, the core movements that really prove this pivot from digital to physical. So our first big movement is in AI infrastructure, but the conversation, it's really not about the chip anymore. We've been tracking for months how AI demand has turned electricity supply and, data center location into the single biggest bottleneck for growth. The GPUs are there, but the power to run them reliably, sustainably, it's just not.
Precisely. We have essentially saturated the grid capacity in a lot of the major hubs. The compute is basically useless without the electrons. Running these models at scale requires the power consumption of a small city.
Right.
And what happened yesterday was a really stark demonstration of this. Capital is prioritizing the physical necessity. Alphabet Google's parent company acquired a major clean power developer called Intersect.
And for how much?
For approximately $4.75 billion.
Wow. $4.75 billion for a power developer. Why is a tech company spending that kind of staggering capital to buy what is, at the end of the day, future electricity? What's the meaning here?
I mean, the meaning is strategic de-risking. It's about long-term supply security. Alphabet isn't just buying energy on the open market and hoping it's green. They're moving to integrate the power sources, the grid connection, and the data center locations into what they're calling a single design.
So they want total control over the input.
Absolute control. And if you look at the economics, it's not just about today's cost. It's energy hedging. They are locking in the physical infrastructure they need for growth, insulating themselves from future price spikes and, local grid instability.
So this tells us that the whole definition of AI success is just fundamentally changing.
Absolutely. It is rapidly moving away from that narrow metric of AI equals raw GPU performance. That's what dominated the conversation just 2 years ago. Now it's a much more complex equation.
It's AI equals guaranteed power.
Yes, and highly efficient grid connectivity and reliable storage solutions. This realization, this is a theme with a huge global weight.
And what's the staying power? Is this just a momentary buying frenzy, or is this a structural change we're going to feel for years?
Oh, this is structural. It has very strong midterm significance, probably until around 2028, as all the major players scramble to do the same thing. But the long-term implication is about regulatory restructuring. Data centers won't just pick a location based on cheap land anymore. They will go where the utilities and local governments can guarantee electrons and, crucially, easy permitting. Capital now follows the electrons.
Okay, so if our first movement was about securing the flow of electrons, our second is about securing the actual physical stuff, the materials for batteries. We've been watching this growing collision between the massive material requirements for EVs and batteries and the equally massive pressure for ethical, traceable supply chains.
And that collision was inevitable. Battery material demand is just soaring, especially for things like copper and cobalt. And this conflict really came to a head yesterday in the Democratic Republic of Congo, the DRC.
And the DRC is the dominant player in cobalt?
Extremely dominant. They hold a huge portion of the world's reserves. So what happens there has a massive real-life impact.
So what exactly happened there?
The DRC government suspended the processing of all artisanal, that's small-scale copper and cobalt. And crucially, they announced this halt will continue indefinitely until legal proof and full traceability certification is established.
The moment you hear suspension and DRC for cobalt, you immediately think, okay, short-term price volatility. Yeah. But you said this is a structural movement, not just a market disruption. How is this changing the actual, the fundamental conditions of procurement?
Right. Because a disruption is temporary, like a mine collapse. A structural reset changes the rules of the game permanently before, companies could manage risk with complex audits and layers of suppliers. Now, the government itself is forcing the issue of institutional rigor. If you can't provide a clear, certified, verifiable chain of custody for that material, it's illegal to process it.
But couldn't this just push sourcing to other countries with fewer rules?
Yeah.
Or, create a bigger gray market?
That's the tension point, and it's a valid concern. But because the DRC is so dominant in cobalt and the ethical pressure from consumers and investors is so intense, the market can't just bypass them. Instead, this forces the entire EV and tech industries into a rapid reevaluation. They have two choices. Either adopt technology like blockchain tracking to meet this new high standard, or invest massively in completely different battery chemistry that doesn't need cobalt. It's a powerful shift.
Okay, shifting gears to the broader energy landscape. Our third deep topic is on oil. The background here is something we've tracked for a while now. Despite all the volatility, geopolitical factors are quietly creating this very sturdy price floor that just refuses to budge.
That's right. What we saw yesterday was crude oil markets continuing to aggressively price in these supply risk factors.
Wow.
They weren't reacting to a new price surge, but just internalizing the baseline risk from ongoing pressure on producers like Venezuela or the situation in Nigeria.
So if the price isn't actually skyrocketing, why does this matter so much to you, the listener? What's the core meaning we need to grasp here?
The core meaning is the internalization of a supply uncertainty premium. It isn't just about what oil costs today. It's about what the market expects oil might cost tomorrow because of non-economic risks. Think of it like adding an uncancelable perpetual insurance rider to the cost of every barrel of crude.
That's a great way to put it. It's a geopolitical anxiety tax on energy. Can companies like a big shipping line or an airline even hedge against that? Or do they just have to eat that cost?
For the most part, they have to absorb it. They can hedge against price swings. But this premium is structural. It's systemic friction. It ensures that prices stay elevated, even when short-term supply looks okay. And this is significant because it just ripples through everything. Logistics, fuel costs, electricity prices. This premium is a constant drag on the global economy.
And this uncertainty will just keep being defined by geopolitics in the coming year. Sanctions, quotas, negotiations. It really just underscores how instability translates directly into a permanent cost for every business and, eventually, for all of us. So we've got the three big tectonic shifts: AI capital shifting to power, resource integrity changing the rules of the game, and a permanent uncertainty premium in energy. But let's zoom in now on the smaller fault lines, the early warning signals that show where stress is building.
We've pulled 5 quick signals that map how the physical world is grappling with this sudden, massive digital demand. First, let's look at Uzbekistan. They established an AI and data center tax exemption zone in Karakalpakstan. They're offering power discounts, government-backed infrastructure, and tax exemptions until 2040 just for GPU and data center implementation.
That is a very clear effort to manufacture a tech base with friendly regulations. But why there specifically? What's the implication?
Well, the implication is complex. It's attractive because it's remote and has some autonomy. But this will immediately test the limits of 2 critical factors: local water constraints, it's a very dry region, and the existing power capacity. They're essentially creating demand ahead of supply, a classic stress point.
Okay, what's next?
Second, in Argentina, OpenAI and a company called Sur Energy announced a massive AI data center plan. We're talking potentially up to 500 megawatts class.
A 500 megawatt class data center is huge. That shows AI capital is prioritizing physical site factors, right? Transmission lines, ports, land, cooling water over the general economic story of a country.
Exactly. It shows that if the physical assets are right, the capital will follow, regardless of other perceived risks. If this works, it will trigger wider regional investment in grid infrastructure and probably talent migration. It proves that power lines and land are the real assets right now.
And number 3.
Third, in Austin, in the U.S., Samsung is pushing ahead with infrastructure upgrades at its existing fabrication facility, specifically for complex waste fluid and processing systems.
That just reinforces the point that the biggest constraints in urban chip manufacturing are not always the cutting-edge tech.
No, they are the city-driven system constraints.
Yeah.
Things like water management, waste handling, environmental permitting, the plumbing, essentially. A city's ability to handle the byproducts of advanced manufacturing is what dictates the pace of expansion.
Okay, 4th signal.
Fourth, turning to Africa. In Lagos, Nigeria, essential city functions like cloud services and finance are getting congested. They're being limited by severe shortages in data center capacity and stable power.
And that perfectly illustrates the physical ceiling we talked about at the start. Lagos's specific structure, the power grid, the connectivity, is setting the practical limits on digital growth, no matter how fast the economy wants to grow.
And the implication is clear. The simultaneous optimization of power, security, and investment is just unavoidable for any high-growth city. Digital progress hits a wall if the electricity doesn't flow.
And finally,
Singapore. They are strengthening their green power, emissions, and land optimization requirements for all new data center applications.
that sounds less like regulation and more like an explicit governmental operation of like a data center acceptance operating system.
Yeah.
They're controlling the exact entry point for any new digital capital.
That's precisely what it is. It reflects their institutional evolution after they had previous capacity strains. And the implication of such a high bar is that it may push certain types of investment, the less efficient projects, toward neighboring regions with looser rules. It's creating a whole new regional dynamic.
So what does this all mean? If we look at the whole picture, from Alphabet buying power companies to Singapore setting new green hurdles, what is the clear takeaway for the listener?
The overall picture is, I think, undeniable. AI investment, which is the dominant force in global capital today, is fundamentally shifting its focus. It's moving away from purely computational hardware, like the GPU, and it is pouring money and attention directly into the physical world constraints. Power, grid infrastructure, regulation, resource traceability. The bottleneck has moved down the stack, from the software and the chips to the dirt, the electrons, and the local city hall.
So if that's the overall shift, what specific junction point should listeners pay attention to next? Where's the tension going to build most intensely?
The most intense tension will build at the junction point of four factors at once. So it's power times, data center times, water and cooling times, permitting. All of those together. Listeners should watch for rising tension in two very different places. First, the physical power shortages in emerging high-growth cities like Lagos. And second, the strict, high-bar regulatory entry control systems in advanced hubs like Singapore. That contrast will define the global geography of compute for the next 5 years.
So the race to accelerate technology is now fundamentally being governed by the ability of local governments and utilities to manage two things: water and electrons. It's a utility story disguised as a technology story. We'll be back tomorrow to continue this deep dive.